When the $45 billion fund collapsed, someone had to buy what it was forced to sell. That someone was Ken Griffin. Citadel took the entire public book in one block, before the market even opened, at the price of maximum panic. But Griffin had been waiting for exactly this. It is the oldest move in capital history, and he has run it before, on funds that were bleeding out just like this one. Everyone remembers the fund that died. Almost no one remembers who was standing on the other side of the trade. Every investor hears the same rule the second the market turns. In a panic, protect yourself. Raise cash, cut your leverage, don't try to catch a falling knife. Every advisor repeats it, every downturn. And for most people, it's exactly right. But the biggest balance sheets in the world are trained to read that same moment backwards. They don't fear the forced seller, they wait for him. Because a market in freefall creates something that exists at no other time. An owner who has to sell, right now, at a price he doesn't get to pick. In July of 2026, that owner had a name. Leopold Aschenbrenner. Former OpenAI researcher, still in his 20s, running a hedge fund called Situational Awareness. He had launched it in September of 2024 with about $225 million. In under 2 years, it returned more than 1,000%, and through the first half of 2026 alone, it was up 439%. At its peak, it sat on roughly $45 billion, all of it riding on one idea, that the companies building artificial intelligence, the chips, the data centers, the power plants, were the trade of the decade. He was long the builders, names like SK Hynix and CoreWeave. He was short the software firms he thought the technology would swallow. And he turned out to be right about almost all of it. His thesis held up fine. What broke was the borrowing behind it. Aschenbrenner was carrying up to $4 of debt for every dollar he actually owned. On the way up, that math looks like genius. Then, in late July, the chip stocks turned, and the same math ran in reverse. The losses hit the borrowed money first, and his prime brokers, Bank of America, Goldman Sachs, JP Morgan, came back wanting more collateral. He couldn't cover it. The fund lost 67% in a single month, and a portfolio that had touched $45 billion fell to around 10. Not everything got sold. The fund's private holdings, including a stake in the AI lab Anthropic, stayed right where they were, because private shares can't be margin called overnight. It was the public book that had to go, and it had to go now. Aschenbrenner didn't choose to sell at the bottom. The machine he had built chose it for him. He did not go quietly to Citadel either. Before the block traded, the fund was weighing whether it could sell down private stakes instead, and it was out looking for fresh capital from investors to plug the hole. Both take time. A margin call doesn't give you any. Once the collateral demand lands, the only question that matters is what can be turned into cash before the market opens. And private positions in AI labs, however valuable, cannot. None of this is new. 1907, 2008, 2021, the same forced seller math has been running for more than a century. What makes 2026 worth stopping on is who was standing there when it did. Because a margin call is not really about being wrong. It takes every decision a man has left and crushes it into one morning, and it hands the timing of his exit to whoever is sitting on the other side. The prime broker who financed him is not his friend in that moment. He's the one asking for the collateral. And the buyer waiting with cash isn't braver or smarter than the seller. He just held on to the one asset that gains value in a panic, the ability to move when nobody else can. So here's what actually happened on that Thursday morning. Aschenbrenner's public equity book, roughly $16 billion of it, went to Citadel in a single block before the market opened. Longs and shorts together, one transaction, at a discount reported at around 10%. The two prime brokers holding the exposure, Goldman Sachs and JP Morgan, helped structure it. And because that entire block never touched the open market, The sell-off that should have hit every AI infrastructure stock on the tape simply didn't happen. AI names rallied on the news instead. Understand what that structure avoided. A book that size, sold into the open market on a normal morning, moves the price against itself with every order. The first sales go out near the quoted price, and the last ones go out into a market that has already worked out what is happening and stepped away. Every seller in a panic is bidding against his own remaining position. Taking the whole thing in one block, off-market, before the open, removes that spiral completely. It also means only one buyer sets the price for all of it. Griffin didn't just buy cheap, he got paid, in effect, for being the only one big enough to catch the thing as it fell. And this is where the story stops being about Aschenbrenner at all. Because Ken Griffin has done this before, and the pattern is his, not the market's. When Amaranth Advisors blew up on natural gas in 2006, Citadel, alongside JP Morgan, took its entire energy book, and Amaranth paid $2.5 billion in concessions for the privilege of being rescued. When the GameStop squeeze was tearing Melvin Capital apart in 2021, Citadel and Point72 put in $2.75 billion, and Citadel took a cut of the revenue on the way through the door. Notice what all three have in common. Griffin didn't predict any of them. He wasn't early on natural gas, he didn't call the GameStop squeeze, and he didn't see the AI sell-off coming any better than Aschenbrenner did. What he had, every single time, was a balance sheet sitting ready and a phone that rings when somebody desperate needs an exit before the open. In this case, that balance sheet ran to roughly $70 billion under management by the figures reported around the deal. And Citadel wasn't a skeptic being talked into AI either. It had already doubled its Nvidia position to nearly $4 billion and added $2.5 billion of Amazon earlier in the year. So when the block came up for sale, Griffin wasn't buying a thesis he had to be convinced of. He was buying more of what he already owned, at a discount, from a man who had no choice but to sell it to him. This is the rule the capital class actually lives by, and it's the exact opposite of the one everyone else gets taught. You're told the crash is the risk. For the people sitting on the deepest balance sheets, the crash is the opening. It's the one moment a great asset and a desperate owner land at the same table, and the buyer gets to set the terms. Aschenbrenner saw the shape of the AI economy clearly, and he might still be proven right about every company he owned. But if that thesis pays off, the person who cashes in won't be the analyst who called it. It'll be the man who bought those same positions off him at the bottom, while the fund that found them was being carried out the door. Today, those holdings sit inside Citadel, picked up at the price of a panic Griffin never caused and never had to predict. The forced seller makes the headline. The buyer makes the fortune. Aschenbrenner had the thesis. Griffin had the balance sheet. Only one of those survives a margin call. Subscribe. Wealth Cipher follows how real money actually moves through every panic, every collapse, every forced sale, the way the families who outlast them always have. The last video showed you the man who built that $45 billion fund and watched leverage tear it apart. This one showed you who was waiting when it fell. The cipher has always existed. Now you know where to look.